Right. So in the 3 months from November 2022 to Jan 2023, long duration funds or LDFs have seen net inflow of rupees 732 crores. Not just that, in last 6 months, four fund houses, Aditya Birla Sun Life, Axis Mutual Fund, HDFC and SBI Mutual Funds have launched LDFs, long duration funds. Now, this indicates significant investor interest in these schemes. So, what actually makes LDFs attractive at this current moment, and why are investors locking their money in? Let's bring on board Jayesh Faria, Associate Director, Regional Head West, Motilal Oswal Private Wealth, to understand all of this and more. Jayesh, good evening and welcome to the show. Clearly, we are going to talk about long duration funds and the growing interest. As the data that I just shared, the category also managed assets of the tune of rupees 3,718 crores as on Jan 31st. 2023. Now, what exactly is happening, Jayesh? Because long-term investors are looking to lock in high yield on the long-term bonds in a tax-efficient manner, which is keen on long-duration funds. What is this trend? How do you decipher the kind of raising interest despite the RBI yet to pause rates?
First of all, thank you, Kavita, for having me on your show again, and a warm welcome to all your viewers. And as you rightly said, there is a renowned interest in long-duration funds. Let me jog the memory of all your viewers. As you know, this phenomenon started in 2007-8, post-financial services crisis. I think the majority of the central banks across the globe started with easy monetary policy. Now, monetary policy is one of the weapon central banks use because central bank has a tough task of juggling between growth and inflation. So when we were hit with financial crisis, majority of the central banks adopted an easy monetary policy. And they made money cheaper, and that's how interest rate globally came down. And when it was time for them to go back on their policy, they started cutting down on that easy monetary policy. We were all hit by COVID. And COVID again forced all the major central banks to move on to an easy liquidity policy again. So again, we moved to easy monetary policy, and as you know, as India was quite immune to financial crisis which happened in 2007-8. At the time of COVID, it was unknown and it hit all of us together. So like all other central banks, Reserve Bank of India also moved towards easy monetary policy. They started bringing the interest rates down. And by bringing the interest rates down, this is the first time Indians have experienced a low interest rate scenario. And as you know, majority of the Indians who are born in 40s and 50s have been traditionally doing their investment in bank deposits, gold and real estate. And this is the first time during COVID, Indians realized that all these three favorite asset class of Indians did not do well. They started earning lesser returns. And that was the time that a lot of people moved in towards equity mutual fund, etc. And the flows dictate the same. But what has happened post-COVID, and India was one of those economies which recouped very well. And we since majority of our economy is dependent on domestic growth, the growth came back, and so RBI started increasing the rates across the policy rates. So we have seen as low as from 6% to 7.5%. RBI nearly increased 250 basis of interest rates, and that's how the fixed deposit rates in India started going up. Now, majority of the advisors feel, majority of the wealth managers feel that interest rates have peaked out, and that is the reason you are seeing a renowned interest in locking in this yield towards long-term direct bond funds. And that's why you are seeing this inflows coming in last 4 months, or fund house launching that many more schemes.
Exactly. Now let's break this down further, Jayesh, because the long-term bonds generally lose value when interest rate rises. However, smart investors sense an opportunity when the interest rates are nearing their peak. How here the upward pressure is limited on the interest rate? Could you just explain us that?
That's right. As I said, RBI will increase the interest rate, and since majority of our economy depends on domestic growth, we feel that the rate hike as towards the peak, we may see another 25 basis point rate hike in India, but otherwise we have peaked the duration because growth has come back. And the second important factor in economy is inflation. Inflation is showing the signs of RBI's range of 4% base rate plus or 2% here and there, plus 2% or minus 2%. So inflation looks to be coming under control, and that is the reason we feel that interest rates in India has peaked out. And now is the time that if you lock in at this rate, as you rightly said, when interest rates go down, you tend to also get capital gains over and above the yields or a coupon yield which you make. And that is the reason this is a good time to lock in at higher rates.
Right. What about the short-term volatility? The yield to maturity stands at 7.48%. Modified duration stands around 9.43 as far as the LDFs are concerned on average. But now, if we park in money, are you also nullifying the short-term volatility, or that's obvious? That's going to happen.
Short-term volatility is going to happen because that's the nature of bond market. But since if you look at the instruments through which you can participate, say mutual funds. So if you're looking at a debt mutual fund, anyway it is tax efficient to stay put for this mutual fund for 3 years. Because post 3 years you can claim long-term capital gain. And that is the reason that short-term volatility may occur or will occur. But locking at this rate, and if you're going to hold to maturity, you tend to get all the coupons, and in between, if interest rates come down, you will make some capital gain and you can exit at a higher rate than the prevailing interest rates.
Jayesh, could you also explain us the nature of these schemes? Where do these schemes invest? What is their investment duration? And does it depend from fund to fund? What is the kind of strategy a fund manager really adopts for long duration funds right now?
So broadly, in this long duration fund, which you took the name, 4 of them which are launched currently. So there are 2 types of risk when you're investing into long-term bond. As you rightly said, one is interest rate risk and second is credit risk. Now in long duration bond fund, majority of the fund managers are avoiding credit risk. They are only looking at interest rate risk, and that's why they are choosing Government of India bonds or any of the sovereign or a state bond, or a very, very high-end AAA rated corporate bond. But their whole focus is to play interest rate and not the credit risk. And interest rate, as I said, the cycle has peaked out. We may see going forward in next 1 to 2 years, we may see a rate cut. If the growth happens as per estimate given by RBI, then automatically interest rate in our country will come down. And that's the reason it will be a good idea to lock in your rates now.
A lot of time investors confuse these funds with target maturity funds also. Could you please explain the difference and what exactly is a target maturity fund also?
So the target maturity fund, as you rightly said, is hold to maturity. If you buy a 5-year or a 7-year target maturity fund, though there may be internal volatility, but they will hold these bonds for the maturity. So for that, it is important that maturity of the fund and the investor who is investing into fund align their investment approach towards this fund. So if you stay put, you will get the yield or a coupon which is associated with the bond despite of being volatility. How it is different than long dated bond fund is, long dated bond fund you may invest or investor may invest with 3 to 5 year view, but they are currently looking at investing into 7 to 10 year paper. So a bond will mature over a period of 7 to 10 years. You may invest into this fund with 3 to 5 year view in mind. So you may face volatility when you are exiting the fund, and that's how it is different than target maturity fund. The target maturity fund locks in rate as well as locks in investor to stay put till the maturity of the bond. So despite of volatility, they earn coupon. But in long-term dated bond funds, you still take interest rate risk, and the volatility of interest rate can affect your returns.
So in this scenario, how do you recommend an investor should be putting money? Should it be in a conservative way? Because if we are talking about long duration funds, we also can assume an investor is not is really risk averse to a certain extent. Conservative investors, if they want to put money into this, should they be opting the staggered way of investment?
The conservative investor doesn't need to stagger his investment, because if interest rates have peaked out, this is the time to lock in your rate. But rather than staggering their investment, what they should look at is the portion of their debt allocation. They should divide between 3 parts. One is the money which they think is emergency fund and they may need it in less than 1 year. those kind of investment, you should look at liquid fund or a short-term fund kind of opportunity. And the fund which they are sure that they are not going to need over a period of 3 to 5 years, and they are okay with volatility in those funds, those are the funds which should go to long debt funds.
Okay. And what about high net worth individuals? For them, is it a better option to earn money on a fixed coupon rate?
That's right. All high net worth individuals also do allocation towards the debt fund. And as you know, in this finance bill, the market linked debentures are now fully taxed, and the opportunity for high net worth individuals from a long term perspective to lock in rates, these long dated funds are also a good opportunity.
About gilt funds, why aren't we talking about that when we are talking about this category? Are they really not yielding good returns for investors, or are they too risky?
It is good return for investor. The risk is the volatility. If you are coming into a fund with 3 to 5 year view, since interest rate, you are entering into a cycle where interest rates are peaked out, you may see internal volatility happening. But from a long term, which is 3 to 5 year perspective, these are good investment opportunities to look at.
Because over here, the gilt funds in Jan have seen outflows of around 56 crores.
That's right. The gilt funds, the very nature, as I said, there is no credit risk because these are sovereign. These are issued by government of India, so there is no credit risk. But gilt funds or government of India security, as it is called, is very sensitive to interest rate movement. And interest rate, since in a country like India, the majority of the borrowing is done by government of India. So if we look at our economy, our largest borrower in the country is government itself. And whenever government does any action of buying bonds or issuing new bonds, in market it creates short-term volatility. And that volatility is what gives discomfort to investors. And that's why there's normal conception among the investors that gilt funds are risky because they are highly volatile. And because it is highly volatile, people stay away from it. And that's why you see redemptions or purchase whenever there's movement. Since interest rate in last couple of months have gone up, and that's the reason you are seeing redemption happening from gilt funds.
Jayesh, could you also explain us the capital appreciation part in long duration funds? What's the maths behind that?
The capital appreciation, suppose today you buy a bond which is a 10-year maturity and you are getting say 10% yield. So 10% is the cash flow you will get every year for the bond which you have bought. Provided interest rate in the country is say 10%. So when interest rate is 10%, you're getting a bond for 10 years assuring you 10%. When the interest rate goes down to 9%, the bond which has committed to you to pay 10% over a period of next 10 years will have a premium on that bond. So today if you want to buy a bond which will give you 10%, but current choices available is 9%, so this bond will fetch a premium, and that premium is called capital gains. So if you go to sell this bond today, a new investor to get the bond which gives him 10% will give a premium over the par value, and that's the capital gain our original investor will get when he trades this bond when interest rates go down.
And how are LDFs tax efficient, Jayesh?
LDF majorly is launched by mutual fund. It's not tax efficient because you have to hold like any other debt instrument. This instrument for more than 3 years if you're entering through mutual fund route, so which is on par with all other mutual fund investments. Here it aligns with investors' interest because you want to lock in rates for long term. And if you are locking in rates for long term, after 3 years you get long term capital gain. So it's tax efficient because it meets your criteria of earning this high interest rate for longer duration, and that's why you stay put with the fund for a longer time.
All right, I think that will be all. Thank you so much, Jayesh, for removing time and explaining all these things in depth and detail to our viewers today.
Thank you, Kavita. Thank you very much for having me on show.
Thank you. And on that note, let's take a quick break, and after that, let's talk about UPI scams.